Today, we're looking at the $7.5 billion tug-of-war that has been taking place between Mondi, the South African paper giant, and International Paper of Tennessee to purchase DS Smith, the British packaging company. This saga began in February when Mondi made a takeover approach for DS Smith. It was an all-share offer which valued DS Smith at £5.14 billion, or approximately $6.7 billion, and would have resulted in DS Smith shareholders owing 46% of the enlarged Mondi company. Not wanting to miss out on the party, International Paper quickly submitted a rival offer in April. It was again an all-share offer, but it valued DS Smith at £5.8 billion, approximately $7.5 billion, and would result in DS Smith shareholders owning 34% of the enlarged entity. Just to complicate matters a little bit more, Suzano, the Brazilian paper producer, entered the fray in May with an all-cash offer of $15 billion. However, this wasn't an offer to buy DS Smith. Suzano wanted to buy International Paper, and their offer was contingent on International Paper dropping its takeover bid for DS Smith. So, now we had a situation where one company was in receipt of two competing takeover offers, but where one of those takeover offers may fall away should a third-party takeover prove successful. Are you following this trail? Well, let's cut to the quick. International Paper decided it had no interest in being taken over and sent Suzano packing. Did you get the pun? Ok. So, now we're left with the two takeover offers for DS Smith. The directors of DS Smith, being a rational bunch, decided they preferred the $7.5 billion offer more than they liked the $6.7 billion offer, and they agreed to merge with International Paper. Last week, the shareholder of DS Smith and International Paper voted to approve the proposed merger, and so the deal looks set to close later this year. So, you may think, given the bidding war, that there could be a nice payday for an arbitrager here. Let's take a look at the numbers and see what one could expect. As we mentioned, this is an all-share takeover where each share in DS Smith will convert into 0.1285 new International Paper shares. An arbitrager will therefore need to take a long position in DS Smith, short 0.1285 International Paper shares for each DS Smith share, and wait until December when the two positions will cancel themselves out and cash will land in their brokerage account. Such an arbitrager will need to be mindful that they will be liable for a dividend payment of 43 cents for each full share of International Paper shorted, but will also receive a dividend of 8 pence for each DS Smith share held. So, what does this translate to in cold hard cash returns? We calculate an investor participating in this deal can expect a return of just 2.57%, which, because of the short holding period, translates to an annual return of 15.63%. Due to the high probability of the deal closing, the risk-adjusted return is 5.6%, but the expected loss, should the deal fall apart, is 23.84%. Not the most spectacular return one could imagine, but let's take a look at what you could have won. If you had been paying attention to the takeover of the markets and took a position in DS Smith in April, when International Paper made their offer, the return would have looked very different. At that time, DS Smith was trading at £3.40 and International Paper at $33.83. An investor committing at that time could have expected a return of 4.83%, or, due to the longer anticipated holding period, an annual return of 7.41%. And due to the greater uncertainty before the boards of directors had agreed to the deal and the shareholders voted in favor, the risk-adjusted return stood at negative 11.64%, and the expected loss at 33.14%. We can see between these two scenarios, where the time frame and uncertainty are reduced on the left side of the page, that the absolute return is lower, but the annual and risk-adjusted return are both superior. The question you may now be wondering, what would have happened if, at the time Mondi initially proposed taking over DS Smith, you took a long position in DS Smith, without shorting Mondi or eventually International Paper, and held those shares until a deal was agreed? How much could you have made? Now, I should mention A position like this would be an outright speculation, with no short position to lock in a risk-free exchange, known as a naked long, and no confirmed deal. But hey, this is the age of Wall Street bets, so let's run the numbers to see what a degenerate gambler could have earned. Taking a long-only position in DS Smith on the 8th of February would have cost £3.09 per share. There would be no short position, and so no dividend to cover. However, you would have received 20p in dividends on the long position. You would also need to closely watch the transaction and eventually sell your DS Smith shares at an opportune price, and before they converted into the shares of the acquiring company. Now the share price of DS Smith continued to rise over the next few months as the suitors battled it out to take over the company, and since the end of June, the company has consistently traded above £4 and 20p per share and as high as £4.85 per share. If we assume the speculative investor sold out at a midpoint of £4.40 in August, we can calculate the expected returns. This speculation would have earned a return of 49%, or an annualized return of 92.18%. The risk-adjusted return is slightly less at 28.54%, and the expected loss, should the deal fail, was 12.51%. Now, with this particular instance, it appears that a naked long position in DS Smith, as soon as the takeover was announced, would have generated the better return, but hopefully, obviously, incurred a significant risk profile. And to note very clearly, this is most certainly not financial advice. Anyone entering into speculations like this can expect to lose money more times than they profit. But there we have it, a three-way tussle between the USA, South Africa, and Brazil to determine the future of a British paper and packaging company. So, what does everyone think of this deal? Let me know in the comments below, and don't forget to like and follow if you found the video useful. Be aware that all the figures mentioned are at the date of my calculations and will change in line with the share price, any changes to the deal terms, and the duration to close. As always, this information is provided for educational purposes only. You should not consider anything in this video to be investment or financial advice, nor a recommendation or endorsement to buy or sell any financial instrument. You should always conduct your own research before considering any investment and seek independent financial advice. Thank you for joining me today, and until next time, have a great day.